the Eurozone raises interest rates for the first time in 11 years. On Thursday, the ECB increased its key interest rate by 0.5% and plans further hikes this year. Bloomberg's forecasts indicate that the ECB interest rate will reach 1.2% at the end of the year. We have had negative interest rates in the UE since nearly 2014 to accelerate economic growth after a long period of weak growth. Negative interest rates had encouraged banks to lend rather than deposit money with the ECB. The increase in interest rates is the response of the ECB to the rate hikes of the Bank of England and the US Federal Reserve, which are trying to fight inflation. It is worth adding that the passive attitude of the ECB resulted in a value decrease of euro against the dollar to the level of €1 to $1. It is the lowest level in 20 years. On the other hand, inflation in the Eurozone has already exceeded 8%. Inflation ranges from around 6% in Malta to over 20% in Estonia, as we can read on the ECB homepage. High inflation is a major challenge for all of us. The ECB Governing Council will make sure that inflation returns to its 2% target over the medium term. It is not just a step, it is a journey, said ECB President Christine Lagarde. Looking further ahead, the Governing Council expects to raise the key ECB interest rates again in September. The calibration of this rate increase will depend on the updated medium-term inflation outlook. The forecasts for the Eurozone are not very optimistic. Rate hikes take place at a time when the European economy is weakening sharply and is facing a stagflation shock that is beyond its control. What is stagflation? Stagflation is characterized by slow economic growth and relatively high unemployment, or economic stagnation, which is at the same time followed by rising prices. Inflation. Stagflation can be alternatively defined as a period of inflation combined with a decline in the GDP. Consumer prices in the Eurozone rose on average 8.6% last month from a year earlier. The last time inflation was this bad in the region, the euro didn't exist. That has placed the European Central Bank in uncharted territory. The European Central Bank has acted more slowly to rein in inflation than some of its international peers, such as those in Britain and Canada. Europe has been hit hard by sources of inflation that are out of its control, such as the global supply chain disruptions and rising energy prices caused by Russia's invasion on Ukraine. Even after the unexpected half-point increase, the bank is moving much too slowly toward an interest rate level that is enough in view of high inflation. Jürg Kremer, the chief economist at Commerzbank, wrote in a note to clients. According to an analyst at Principal Global Investors, there is no central bank in developed markets that is in a worse shape. One thing is certain, the stage that lasted from 2014, where the ECB kept interest rates below zero, is over. There is now a new phase in the euro area that is unlikely to end soon. The ECB has taken a new direction in which interest rates will be gradually raised to try to fight inflation. The word try is not accidental here, because you can't fight 8% inflation when we raise interest rates from negative 0.5 to 0. It's like shooting an oncoming train with an air gun. However, the decisions made by ECB suggest to us that changes are coming in the European economy. What does this mean for the economy? As we can read on BBC, the idea is that by making it more expensive to borrow money, people will spend less, bringing down demand and therefore prices. However, there are also concerns that higher rates could push them into recession, which is defined as 2 successive quarters of economic decline. It is worth noting here how the rate hike will affect such countries from Southern Europe as Spain, Portugal, Greece and Italy. There is a problem whether in this situation the UE will be able to finance its debt service, which forerun trouble. There is a risk of bankruptcy of the mentioned countries, which may result in the collapse of the Eurozone. As we can read on CNN, the ECB mentioned a new bond buying tool aimed at keeping a lid on borrowing costs in highly indebted countries, such as Italy and Greece. The central bank wants to maintain cohesion with the region that uses the single currency, so printing money to buy the debt of the most indebted countries is likely to continue. This is a chart that shows what assets the ECB has purchased over the past 20 years. Consolidated balance sheet of the Eurosystem as at 31st December 2021. We are experiencing a new economic era, German Finance Minister Christian Lindner said, which suggests that central banks are currently implementing solutions that we have not been able to observe in the past. The Eurozone is facing economic pressure, with hopes of a strong post-pandemic recovery, dashed by overstressed supply chains and threats to Europe's energy supply. For this reason, the ECB had hesitated to raise interest rates despite the rising inflation. What's very dangerous and important, Italy, the second most indebted Eurozone state, seems to be on a point of collapse. If we add to this the fact that new lockdowns appear in China every now and then, problems with food production in Ukraine, ongoing fires around the world that destroy crops, farmlands, entire livestock, we may have concerns whether the ongoing recession is only temporary or is this just the beginning. President of ECB, Ms. Lagarde, explains the difficult situation in Europe because of the strong dependence on Russian gas and oil, which is why the conflict in Ukraine has a much stronger impact on Europe than other regions of the world. The president of ECB, Ms. Lagarde, explains the difficult situation in Europe because of the strong dependence on Russian gas and oil, which is why the conflict in Ukraine has a much stronger impact on Europe than other regions of the world. Due to the ongoing conflict in Ukraine, broken supply chains and a pandemic that has lasted for 2 years, the management board of the ECB was very careful in introducing changes to the UE monetary policy. There was a concern that, for example, rising interest rates would affect the already difficult economic situation in Europe. On the other hand, due to accelerating inflation and the weakening of the euro against the dollar, the ECB had to finally yield and change the rate at which the policy had been conducted for over a decade. The president of the ECB, Ms. Lagarde, suggests that the fight against inflation and therefore rising interest rates will continue until inflation falls back to 2%. Seeing the actual operation of the ECB, one can get an impression that this fight may last for years. We wonder how the ECB intends to deal with a growing debt of countries such as Italy or Spain, because monetary tightening will make this country increasingly put pressure on the ECB, threatening to enter the euro area. We have interesting times ahead. Thank you so much for watching. Please give us thumbs up, subscribe to our channel, and see you next time. Bye.